Spencer, welcome to the show. Thank you so much for joining me.
Oh, Felicia, honored to be here. Thank you so much for having me on.
Really good. We've been spending some time chatting, getting to know each other offline, not in you guys' presence anyway. And Spencer is in California, Northern California, San Francisco. You guys heard his intro, has been in FinTech, is now the CEO of Madison Investing. Okay, so you're in FinTech, so obviously you went to college, you did that kind of thing. Where did you learn about money? Tell us your money story. Were you born? Is your mom and dad in investing and doing all that kind of stuff, or how did you get to where you are today?
Yeah, gosh, it's a journey for all of us, isn't it? So before fintech, I look back and I was a kid who prided myself on being rather anti-establishment. Frankly, I thought I was playing in punk rock bands and metal bands and playing guitar and thinking I was pretty cool. And I had very little interest in money, very little interest in business. And thankfully, my dad exposed me to some real estate entrepreneurship early on. And just
Okay.
like what does it look like in practice to see someone managing and growing a business? And so he was a real estate broker for 30 years. And he was in the Bay Area, California. He ended up having me work open houses, clean out fridges at properties to prepare them, the really the gopher
Yeah.
stuff, the
Yeah.
intern stuff.
Yep.
And so that was my first exposure to entrepreneurship, but also to money and to start understanding like, oh, why does he wake up at 4:30 in the morning? Like why would anyone want to wake up that early and work that hard? And I don't want to take it too grim, so please, stop me if it goes there, Felicia. But there was this decade of time, and it was around the time my dad's business was thriving in the '90s, and it was very high heights. We had one major income for our family, and that was active income earned by him. And
Okay.
we got hit with this really challenging, dark decade. Basically, when we look back at it, we call it that. We lost our younger brother to cancer when he was a teenager. Lost a few folks in the family, very, very rapid succession. And it was tough. And I look back at that time in a very clear way now in hindsight, but my dad's business shrank. And as a result, the household income significantly decreased. And so I'm not going to act like we were out on the street and we were poor, but
Yeah.
the lifestyle changed
Mhm.
markedly.
Mhm.
And as a kid who was sitting there watching this go down as a teenager, and then later when I was off at college, I look back and I'm like, okay, what are the learnings to be taken from this now that I'm a father of two and we've been entrepreneurs now for coming up on 8+ years after the W-2 career, and I'm like, "Okay, that one active income, it was all that family setup had, right?" Like,
Mhm.
that's what we had coming in, and I just like, I have to quote the book because it's the best visual that ever taught me about money as an adult when it came to cash flow, which is Rich Dad, Poor Dad. We've all read it. Kiyosaki talks about the pipelines and the buckets. The buckets is the figurative example of carrying over that active income from a day job or from being a broker or for whatever, dump it on the table, and you have to go back and fight for it again, bucket after bucket. And we didn't have that. Our family didn't have that. We didn't have a pipeline.
Mm.
And the pipeline is ultimately what it stuck with me. That visual stuck with me now as an adult in the years that we were building up our business. And so I really think about that experience watching my dad's business go through those stages as like the in practice example of the biggest money lesson, at least for generating income, which is like,
Yeah.
hey, if you don't have diversification of income streams, you could really be in some hot water much more quickly than you realize. And even having a day job, is not
Yes.
quite as stable as you might think.
When your dad's business really shrunk, was it due to, I understand the dark decade, and was this he was not able to function like he had before because of all the ick and stuff that goes on, all the way that hits you emotionally and the kind of things that I talk about all the time is you never know when your child's gonna get sick, when your mother, father's gonna get sick and need you to be there. And if all you have is your one running the wheel, you gotta go to work. If you stop doing that, money's not coming anymore, you have a problem. Okay.
Nailed it. Yeah, you nailed it.
It
It was a combination of that perfect word of the ick. So it was the ick, and it was also some of those Herculean things that parents do when their child is sick, which is,
Yeah.
flying across the country for some more experimental cutting edge stuff. That's very expensive.
Yep. Yep.
And so it was a combo of a few of those things and the inability to just drive a very hands-on business that is being a broker.
Yep. And so your initial thing was to go to college, you get into fintech, and I'm gonna make a bunch of money, and then it was after you're already there that you started to see that I'm in the same position my dad was in. Now I've got 2 kids, and if something happens to this job or something happens to one of these kids,
Mm.
all I got is this money coming in, and we've gotta do something different. And is that when did you read Rich Dad Poor Dad in that time, or had you read it before and just hadn't implemented anything?
It's funny you asked that. I think so many folks were handed that book when they were young, and they were kinda like, "Yeah, whatever." I was probably one of those kids. I remember having it, maybe I glanced through it at one point, but I was like, "I just don't care." As an adult, during that period of time, you nailed it. Like, I picked up that book. It was given to me by a coworker. I was
Mhm.
fortunate to have worked in the fifth FinTech company I was at, and it was a real estate tech company that we would like lend to fix and flips. And
Okay. Uh-huh.
this coworker gave me the book. He's like, just read this, man. Just read it. I know everyone says that they've read it, but just think about the concepts. And Jennifer, who's my co-founder of our business and my wife and mother of my children,
Mhm.
she and I both had stable careers, quote unquote stable, and really great W-2 income throughout that period of time. Like we were packing up the 401ks, feeling very, very confident about our retirement account, patting
Right.
ourselves on the back for all these
Yeah.
maxing out those accounts. But
Yep.
when I got the book, I was like, well, none of that applies to us. We're still decades away from the official retirement age to draw these
Mm.
down. So what are we going to do about that? And that was really the catalyst is when I got my hands on it while walking into a day job to lead teams of people and grow teams of people in fintech. You feel like, oh, I work in tech companies that solve for things like I worked at Intuit for 5 years. They do a third of the country's taxes like that. And they do QuickBooks. So you would think I soak up some of those financial learnings along the way. And in reality, it's like corporate acumen is not the same as in practice financial literacy.
Yes. Yeah.
Totally
100.
different.
Yes. And that right there, financial literacy and your smarts that you got from going to medical school, law school, call all those things, it's completely different because they don't teach us this in our
Mm-mm.
schools. So you get that's a school of hard knocks lessons is what they are. Just that's what they are.
That's right.
Or you can learn from somebody who already went through the school of hard knocks and have less knocks or different knocks than those folks. But
Yeah,
so
and hopefully borrow their learnings in at least in theory, so you don't have to go through the tough version of that in real life in
exactly.
practice, right?
Exactly, because I don't know about you, but I lost a whole bunch of money not paying attention to not taking my lessons from other people and thinking I can do it myself, which is a medical professional flaw. And after I lost all that money, it's like, "Okay, maybe I better pay attention to somebody else here."
Well, just briefly on that topic, I want to mention that you hit on a very common theme that I hear about from I've gotten to know many very capable medical professionals as we built our
Mhm.
investing club over the years and like brilliant people who I'd see in the tech world too. The
Yeah.
smartest, most capable, most educated people have a very DIY at all costs attitude. That is part of the reason that they are successful in life. And the downside of that is that sometimes it is truly better to not DIY.
Yeah. Especially when it comes to your money because we don't know, and learning it can be a very, very painful lesson. It's just like for some people, they lose that hundreds of thousands of dollars and think there's no way. There's no way. Real estate, there's something wrong. People are lying. They're not doing all these stories aren't true about how well people are doing and they opt out and then just keep in
Right.
their thing until they retire. And we always talk about I don't know what the government age for retirement is going to be when you get there and how all that's going to work for you. But I don't know. Having income coming from somewhere else to me is the key to everything. Living the life you want.
Absolutely.
Getting your time back, what you talk about and what you mentioned is helping these busy professionals get that most valuable asset back, your time. It's key. Being able to spend the time with your family or do whatever you want to do is what we are always talking about. All right. So you just talked about your 401k and how you and your wife had maxed it out and you were ready to, we're going to be working here until we're 105, whatever the government says we can. We start drawing down our money. And then you realize, okay, this isn't, it's not helping us today. So there are ways that these vehicles can help you today. Your 401k, IRA. There's another word called an EQRP, and I'm going to have you explain what that is so that folks can understand that. It's a kind of a newer term as far as I know. A lot of people haven't heard of it, but using those to help fund your investments. Let's just
Mm.
go that way.
Yeah, and this is stuff that really I find to be very cool now, but in hindsight, I was like overwhelmed. There's so much terminology in every single field. But
Yes.
when it comes to retirement, I am still completely befuddled why this type of investing for everyone out there's retirement has been turned into something that is so distancing and so much
Mhm.
jargon because everyone needs it. Everyone will retire at some point. And it took a lot of work to go research this stuff, Felicia. You're familiar with this, but if
Yeah.
there's listeners that are out there and you have not gone down the rabbit hole of like, what are different types to self direct my retirement funds? Oh my goodness. Is it worth it? Yes. Is it overwhelming at first? Absolutely. But to give you the context, I left the W-2 world in 2019, 5 months before COVID. That was not part of the plan, but that's how it went down. Entrepreneurship, right? And I had 4 legacy, like, leftover 401k accounts, and those were from 4 different startup companies I had spent time at. In the tech
Okay.
world, a 2-year run is considered a long run
Long
in the
time.
tech world
Okay.
for context for folks. So I
Okay.
had a bunch of these leftover 401ks. And, well, most people, if you look at the data, they just leave them there. Like, and there's nothing necessarily wrong with that. But I decided after about a year I was like, I got to do something. I got to take action. Like these accounts are just sitting there. So at first, I rolled them all together, put them into a Vanguard IRA,
Mhm.
waited a while longer. And then I was like, wait a sec. I forget what podcast it was, but I heard someone mentioning that I could self-direct it. And I was like, I'm not quite sure what that means yet. But in the big world of investing in alternative assets,
Mhm.
I couldn't go unless I did this. I couldn't go and say, I want to take that $100,000 from my retirement account, which has grown substantially, and I want to put that into a self-storage facility or a apartment building or it's just or precious metals. Like these are all just alternative asset types that I've invested in now with my retirement accounts. And so you can do that if you have the right type of account.
As opposed to, I'm gonna slow down 2 things. Neither one of us are accountants, so you gotta talk to your own account
Mhm.
people so that you know the right things you can do for yourself. And when you had it with Vanguard or Fidelity, we're not promoting any one company, whatever company you use, your funds are managed by them, correct? And they are investing them. You may be able to tell them different things, but they only have a certain basket of things or 5 different baskets of things that you can put your money into.
Exactly right.
Compared to and the majority of them, you're not doing direct investments into things like apartment buildings, self-storage, the things that Spencer just talked about. So, that's the difference in a true self-directed. Because some people I think some of these companies are calling their thing self-directed and that you get to put it in the thing you want to within their umbrella.
Spot
Okay,
on.
it's
Spot
okay.
on. Yeah, yeah. And I think for terminology's sake, what I started to do is simply just call the whole category of this alternative investing. Like if I'm using my retirement
Mm,
money and it's for something that is not going through a traditional IRA with
mhm,
one of the big brokerages or custodians, when it's not going through any type of traditional retirement account, it's self-directed. Now,
okay,
that saves my sanity. It tends to save the sanity, I think, of some of the newer investors that I'm helping educate on this topic. But
yeah,
to your point exactly, I'm not a tax advisor and I'm not a financial advisor. So I'm just walking through literally, these are the steps that I took with my own
mhm,
retirement account. So folks,
yeah,
please just take that as a page to like,
yeah,
just go research it. There's some wonderful resources out there about this stuff. And if they reach out to me, I'm happy to send them some links I found useful as well. But ultimately, I bit the bullet after I had those accounts sitting there with Vanguard for a while, and I decided to ultimately go for an account. There's 2 different names you can use for it, qualified retirement account, QRP.
mhm,
The one I got specifically was actually a solo 401k. And so without making people's head spin, I'll just say that one was the best fit for me. There's a bunch of others, and it allowed me to roll over all of those IRA funds I had with Vanguard and then I could truly self-direct, meaning like separate account setup. I could literally go review private market opportunities and investments and decide if I wanted to allocate 50K or 25K or 100K. And I've done, I think at this point, over 12 real estate deals I've invested in with it. I've bought some gold and silver with it, even some crypto. In hindsight, wish I hadn't done that particular one I did. Hey, yeah, that's how you learn. But overall, it's performing very well. And so
yeah,
it's not something necessarily I look at and I'm like, okay, it's the silver bullet. You're gonna blow the S&P 500 investments that you have in your 401k out of the water. I am a huge advocate for just broadly looking at diversification, man. Like that's just smart
I agree, I agree,
for everyone. You know,
I agree.
I don't myopically think people should go hell or high water and just dump all of their funds into one type of asset. That's a recipe for disaster. But they should take it broadly and take it from me. Like that is absolutely worth looking into if people are wanting to complement their portfolios with like alternative investments, like the real estate stuff we're talking about.
Gotcha, gotcha. Let me ask you this, we went from your FinTech into Madison Investing. When did you start investing? How did you get you read Rich Dad Poor Dad, talked about the different pipelines and understanding how to have money coming from different things, but what was your first investment? How did you put your foot in the water, or did you just dive deep in and tell us how you got there?
Yeah. It's similar to what we were joking about before we hit record today on entrepreneurship. Like in hindsight, it seems so clear. In hindsight, so I'll say there are 3 phases that we went through. In no way did I feel that clarity at the time. It's like grabbing a figurative machete and trying to hack your way through the jungle and confusion of entrepreneurship, right? So phase 1, where most people start with real estate investing. Jennifer and I drove around all summer in the Bay Area, super pricey market, had the kid in the car. We took literally the whole summer and we found one property that could cash flow, meaning makes enough income. We found a duplex, makes enough income to cover all the mortgage, interest payments, insurance,
Okay,
etc. And that was a $430,000 duplex. So we put down 100 grand on that. It was $200 a month in cash flow, which you do not call life changing. You don't call that a cash flow win.
right?
You call it an education, right? And the irony is we still have it now. But it's got up in value a lot,
Yeah.
but that was our first one. And we were too scared to do the long distance thing. We were too scared to go and fly out and buy something in the Midwest closer to your neck of the woods right now.
Mhm.
But we got on the second one. So phase two, we got up to 5 different single family rentals that we bought out in Kansas City. And those performed much better economically. Though that was 60K on average purchase price, which is still mind blowing for those of us on the West Coast. $250 a month in cash flow on average, which is great.
Let me stop you for a second. So you bought the duplex. In what year did you buy that?
That was back in, I think, 2016.
2016. And you bought it there. You looked for a long time to find something that would cash flow and you wanted something to cash flow. You weren't just going to buy something. It sounds like that you had to maybe feed for a while so it could go up in value and then no, it needs to give us some money. No matter how much money that is, it needs to give us some money on a regular basis. Got it. Did you
Yeah,
guys?
at minimum to cover so we didn't have added stress.
Yes.
We didn't want to create the very common Californian investor challenge, which is you have to pay outward every month just to
You
hold that
feed it.
property.
Yep. You're feeding it. Did you manage it yourself or did you hire a manager? How did you run that property?
Yeah, so on both the long distance ones we got and the local one we got, we went with property managers.
Okay.
And 10% a month, which is painful to pay, but at the same time, so worth it. It is tough to manage the manager. That is my one gripe I will have about this is we still have quite a bit of work that goes into managing them. I say rentals are semi-passive at best. You still got to do work. It's not
Single
like it does it all
families.
for you.
Yeah. Your single families and duplexes, those are, and you have a manager. It's still not completely passive.
Right.
You what got you over the hump to be able to invest where you couldn't see the properties on a regular basis in Kansas City?
I'm gonna have to pull out a platitude here because it's one that a former mentor of mine in my corporate job used to just repeat over and over, and it's ingrained in my mind, which is competence creates confidence.
Yeah.
And so I look at it that period of time, and it was like, man, how do we stretch our dollar further? Because we just dropped $100,000 on this duplex that generates $200 a month, so we got to do something different. I devoured books. I devoured podcasts. I was networking like a madman just
Mhm.
to connect with other folks in the real estate world to understand more, to beef up my education, and to build those relationships to source potential deals and
Yep.
local meetups, going online, going in forums. But it was really 24 books in an 18-month period and
Spending a lot of time.
just devouring and signing up for coaching programs. I think there's unfortunately a ton of ones that are out there that are not too good, but I think that there are really good coaching programs with authentic, well-meaning people where you're getting great value out of it for what you invest. So I've used 4 of those coaching programs in the past, and they're not cheap when you want to pay for them. So that helped. Is
You
just
don't want to pay for them. You have to pay for them so you get what you want. You get what you
exactly right.
get.
Yeah, like
Like,
the free ones, you're not going to get much from.
but let me ask you this, because I think a lot of people are afraid to do coaching. Number one, they don't want to spend the money. And number two, if they spend the money, they want to make sure they're going to get a good coach. But did you know a good coach before you got a good coach? Because it sounds like you
Mhm.
probably had bad ones first or somewhere in there. At least I got bad ones. And then I didn't know they were bad until I got a good one. And yes,
Oh
I spent the
gosh,
money on it. And that's how you learned.
it is how you learn, and that's a great question. I was fortunate in the corporate world to do a remarkable amount of hiring. And I bring that up because it speaks to one's ability to vet human to human. And I think that I'm a big operations nerd from that career. So what I like to do is break things down into their component parts when I'm really trying to understand it. So for me, what I did was I said, okay, let's go find coaching on a skill by skill basis. And
Okay.
so what kept me out of hot water, I think, in hindsight, was I said, the first thing I want to learn is just how to go do the analysis, do the underwriting for that specific type of asset, that type of property we're going to
Okay.
analyze. Thankfully, I got a good education on my day job too. I had to go in for three
Yeah.
and a half years and I was leading learning and development L&D for a real estate investing company. So that
Hmm.
certainly helped as well. But I recommend folks go out and be specific about what is the thing you're trying to learn first,
Mhm.
because that really kept me out of hot water. On the second coaching program, it was a bit lackluster. I didn't do enough diligence on that one. The first one, super duper helpful just to run the numbers. And so I think as it goes over time, you might sign up for a stinker or two. But in hindsight, I think being specific about the skill was really, really helpful to ensure that it wasn't a waste of money, frankly.
Okay. So for you medicine folks out there, what I think I heard him say, and please correct me, is that to get to the answer that you want to get the right test. So we order blood tests, we order procedures to figure out what's going on. So what you want to figure out is like, I think it's this. Let's look at these things to get to that answer. If it turns out that's not the answer, okay, we go a different direction. You want to know what you think you want in your end when you're looking for a coach. Is that where you're going with that?
Oh, I love that analogy. Yeah, that's exactly right. Just be specific. Because a lot of
Yeah.
times I think even you may have gone through this as well. When I first started talking to coaches, I was like, "Oh, I don't really know what to ask to vet them." So it sent me back to the drawing board to really
Yeah.
be like, "This is no different than interviewing for like a senior leader role."
Ex
If it's a VP for a company or senior director, I would spend significant time preparing what are the questions that I'm testing and what am I
Yep.
testing for?
I think a lot of people think that their job skills, the job they have doesn't cross over into anything else, and it's so far from the truth. We know so much about how to find answers. Just use those skills you have to get the answers that you're looking for. And
Gosh,
if
I do agree with that. Yes.
I invest in Kansas City too, and heck yeah, that's a great market. I'm just now selling them all because I'm tired of managing the managers and I'm making good money on it. So now I can go invest in something else. But
Oh,
I
that's awesome.
bought them in 2000. It's the crash, 2010, 2011, all $60,000 houses
Oh, that's a
that,
wonderful time to buy.
that are now selling for 200, 180, just like, and we made money along the way. So you guys work on not having to see everything you invest in. That's the key. And one of my mentors says, live where you want to live, invest where the numbers make sense. So
Love it.
you got to figure out what you're trying to do. If you want to invest for appreciation, then California might be your market. You're going to be feeding a lot of those properties until you're ready to sell them. And hopefully you sell them at the time when the market's up so you'll get your appreciation. If you want money coming in on a regular basis so that you can get your time back, you want to invest where those numbers really, really make sense and you're going to be getting that cash flow. Okay. The other thing that, since we're at the beginning of a new year, you can't do anything about last year, you guys, and your taxes and what you're gonna have to pay. But how do you work your real estate and your investing and think about your taxes and how that plays into your whole passive investing scheme?
Gosh, I used to think taxes were incredibly boring, and I think most people still do. In a lot of ways, they still are. But now there's so many ways that I nerd out on this stuff, and I don't know if you feel the same, but like once you feel like you have some semblance of more control over this, it becomes way more interesting. And
Yeah.
so once I started to invest in rental properties, and similar for you probably, Felicia, like you realize, well, I can make this investment, and every year I get a little bit of stuff to write off. I get some deductions based
Mhm.
upon mortgage interest payments, et cetera. But it doesn't really change that much. It is helpful to be sure,
Yeah.
each property by property. But eventually, in our third phase, we had those first two phases, we started to invest in bigger types of properties, started to invest in big apartment buildings and communities in the
Okay.
Midwest and the South,
Okay.
self-storage facilities, et cetera. And so some of these properties, when I invested in them, I put 25K or 50K. I realized I would get back a tax form and it said, "Oh, I have a negative number on these things." And it's like a negative number. That's a good negative number. It was like a passive loss or paper loss,
Yeah.
and like the good kind of negative number. And that was actually used to offset not only the investment income itself had a tax burden, so it helped with that. It blew my mind. It was like, wow, that tax form, I can also use that negative number from my new investment to offset my income tax from the other properties that I have.
Mm.
And
Yes.
that was when it became very interesting. And so for most people, the thing that I've always, it breaks my heart to have to say it when one of our new members reaches out and they happen to be like, let's say they're a medical professional and they're making a wonderfully high W-2 income.
Yeah.
And they're like, please tell me how to lower my tax burden on this W-2 income I make. And I'm like, well, I don't have an answer for you there necessarily.
Yeah.
That would be the silver bullet of all silver bullets. But what I can say at least is that you can make the investments along the way that you've made more tax efficient. You can lower that investment burden. And I took the extra step, which is probably more hardcore than some folks want to do. And I eventually transitioned to be a real estate professional, rep status, as they say, in the eyes of the IRS. So that means I can use some of those losses, those passive losses against my active income as well. So before I lose people, I'll just say it's super cool when you make investments and you realize some of them can produce paper losses that can help you offset some of your other investments income tax.
And the other thing that I heard is that for those of us physicians, lawyers with that W-2 income that's really high, it doesn't necessarily, your investing in your passive income and your passive losses don't necessarily help your W-2 taxes. But that's where the whole thing about entrepreneurship comes in.
Yes.
You have to consider yourself, if you're going to start investing in real estate, investing in something besides your 401k, you're an entrepreneur and you
Yeah.
just treat yourself like one, become more familiar with things, and you don't have to know the tax code. Just know to ask the questions. And when you start talking to people, it's taken me a long time. And I remember my first accountant that I fired when he told me, you just need to don't take any deductions throughout the year. So you get money back. You'll have to pay so much at the end. I'm like,
Oh no.
okay, thank you very much.
Former accountant.
Thank you very much. I don't think I even talked to him again after that. It was just that kind of conversation, like, okay, time to find another account.
Yeah. Oh my
And
goodness.
And I've been through a few. I've been through, and it just takes some time. The more you learn, the more you ask questions, the more you realize. And you may stay with the account for a long time, and then you learn more and have more questions. And you feel like, oh, you're not quite, I don't think you're quite doing this the way it's going to be to our best benefit. You go to somebody else. And it's just the way business is.
You get out of shop. Absolutely. Yeah, gosh, so much of what you just said resonates. We are on our 3rd accountant. First one, out of respect for him, he was wonderful. I asked him a question about, let's just say, passive losses, and he was like, "I'd have to go research that."
Hmm.
So we said, "It's been a wonderful few years," and we parted ways. Went to the next one, similar challenge eventually. The one we're with currently, wonderful. We pay a little bit more, but for the little bit more we pay, the number of zeros we have saved is immense. And that just comes down to I cannot agree more with what you said about the entrepreneurship hat. The moment that someone goes out and makes that investment into alternative investments, private market, buy a piece of real estate, they absolutely have stepped into the entrepreneurship hat, and whether they know it or not. And so
Yeah.
a lot of times I think people tend to confuse that and thinking it's the same thing as if I go buy a share of Apple stock.
Yeah.
And it's absolutely a path worth walking into the real estate world, but it is it's going to make you get hands on more so than you might realize, and very well
Yeah.
worth it.
Yep, I agree. I agree. So I think I read somewhere where you talk about making sure how to keep your passive income or your passive investments passive. So I know I talk to women and physicians and they want to invest and they might invest in one of the people in my community, Wealth Builders, invested in a single family house that's a sober living community. And she put her
Oh,
money
that's
into
cool.
that great. And then she's like, now she went off to buy her own property to rent and manage. I was like, and she said, "I just bought my first property." I was like, "No, that's your second property." "Oh, yeah, I forgot about that first one because it was so easy." It's like,
Yeah,
that's the key.
that's by design.
That's the point. This should be easy. Yes, you have to know some things, but the hardest part is putting the money out there. Once
Yes,
you've done that, then you're, like, talking about it and figuring out when's my money coming back.
100%. And that is a really good story. If people if they forget about the investment until they get their payouts, their distributions, that can be a good sign.
Yes.
There's nothing blowing up. So earlier I mentioned the whole 3-phase thing. First property, local rental, second property portfolio that we built up to in Kansas City. Each of those was semi-passive at best. There was still headaches. There was still things we had to do. We'd still get notice from the county. Oh, there's a couch sitting on this porch that
Yes.
shouldn't be there in the middle of Missouri. All that said, we eventually found private real estate funds and syndication deals. And these are all just different versions of what I like to think of as like there's another manager that's going to manage this real estate. They found the property. They are experienced. These are called operators,
Yep.
sponsors, bunch of different names for them.
Yep.
These are real estate sponsors. And so I can find them and due diligence them. And I invested in the first one we did was in Alabama. It was an apartment building. We
Mhm.
invested in that. All the work required was only on the front end. And that just means you still got to do due diligence. You still have to sit there with eyes wide open as an
Yep.
adult and sit there and say, I'm going to read this pretty long legal document.
Yep.
Read the PPM, the private placement memorandum, which is boring and long
Long and scary.
and scary. Yeah, well, I will say I'm speaking to a medical professional, so I think that no stranger to technical, lengthy documents, right? But once you do that, and assuming you're with the right team that's highly experienced, like this is, if anything else, this is what I have leaned in on, and what we have done at Madison Investing more than anything is diligencing the who. It's really just leaning hard on that, not just background checks, but making sure you find a team that's going to treat your money with respect and buy a piece of real estate. So I went and did that, and I cut a check for 25 grand on the first one. And then you own a little piece of a big piece of real estate. And that is beautiful and it works because it ended up more than doubling within a very short period of time. Over a course of years, we did no other work besides turning on the direct deposit. And there are, of course, like every other type of real estate, there's risks. You can have the sponsor do something that you don't want them to do. You could have the deal not go well. But
The market turns, COVID happens, all the things that have
yeah,
happened, and you don't get your money back. It happens. We have to accept that these are risks that are out there and which nobody talks about, the risk of the stock market. So people say, well, I'm just going to put my money in the 401k and let that sit there until I'm ready to retire. But you are taking risks.
that's
I
right.
think too. So just because you don't think about it doesn't mean you're not taking a risk anyway. I'm sorry. I just
No, you're
sorry.
spot on. Like the moment we step up the door in the morning, we're taking a risk, right? Like every day is about a risk calculation of some sort. But I want to point out that like we just got our 20th exit for a real estate deal.
Okay.
And that means we invested in it and it went full cycle. And so bought the real estate, ran a business plan on it. We got distributions along the way, quarterly or monthly. And then hopefully sell the property at a profit. And sometimes that's gone home run level. And sometimes that's like, well, particularly the last year, it's been a tough macro environment with high interest rates for some of these
Yeah.
things. And so a couple of them were like, well, I got my capital back and some profit, but it wasn't exactly what was originally planned. But the overall portfolio we're very pleased with. And
Yeah.
so that is just a different way of investing I had never heard of before I started nerding out on this stuff. And,
Yeah.
and that is, it's a beautiful thing, particularly if you're trying to keep your overhead low. Like if you're trying to not add more hours to your plate, but you still want to have part of the portfolio in real estate, in hard
Yeah.
assets.
Got it. So tell us, and I think we're going to spell it out now. What does Madison Investing do? How do people work with you?
Yeah, ultimately, we built this because we're making our own investments for our own portfolio. And during that process, we built out a really good vetting structure. Like, how do we find those teams that are good at doing this, these real estate teams?
Mhm.
Because there's a lot of them. Some of them have barely been doing this for more than months. They just came out of a coaching
Just-
program and more power to them. Like they're walking the entrepreneurship journey, but I don't want to trust my $100,000 investment with someone who's brand new to it.
Yeah. And
But we,
everybody starts out, just put it out there. Everybody started somewhere.
that's
And
right.
the best way to start, just like in residency, if you're a surgeon, you don't go do that first surgery on your own. You've got somebody walking beside you to make sure you don't mess it up.
That's right.
So if you're brand new or you're talking to somebody who's like, they're honest with you and say, hey, this is my first deal. And I have Susie Jones over here who's done however many deals she's done and she's messed up this and then just how she got out of that. And this how you got to have your walking beside you person if you're first. So
And partnerships in this world are huge. To go buy, like if I invest in a piece of real estate that's a 200 unit, $20 million apartment community, then you better believe it takes a village. Like it takes a
yeah,
village of competent, experienced people who are
to
doing
make it
different
happen.
things.
Yep.
Yeah. And at Madison, what we do is we find the teams that are great. We invest in them ourselves. And when we find one that pencils and it passes our vetting criteria, we share it to our investing group and other folks can participate in that too.
I want to be clear again about what you vetted. You
Hmm.
vetted the deal. Yes, the numbers pencil, but you leaned harder into vetting the operator or the sponsor of that deal. It sounds like than the actual, and not that you didn't vet. Don't get me wrong. I know you vet the numbers to make sure that what they're telling you is going to make sense. But if you can't even get past, I trust you. You don't
Hmm.
even look at the numbers, correct?
Spot on. Yeah. And the three pillars, which in no way can I take credit for, but because they've been around longer, is you look at three things on one of these deals. You look at the team, like the who, you look at the market, and then you look at the deal itself, like the business plan. And to your point, if I were to try to assign like a factor to each of these, like how much time and focus is required to put on each of these, over 90% of it goes on the who,
Yeah,
because you can find a killer market all the way down to the block. And that's what we look at. It's not just
yeah,
about, oh, I love Texas, because I do. I love Texas. I love Dallas. We've done a lot of deals there. You have to go all the way down to, is it in Plano? And what block is it on? And so all the way down there, but none of that is even worth it if you haven't looked at the team in the who. We do that with a 5-part vetting framework. And just briefly, I'll just call this out because we look at these kind of buckets. We look at the actual track record of that team. Like, have they done it before? And are they prepared to go do it again because they know what they're doing?
uh-huh.
We look at their approach. And the approach very specifically means, I won't bore you with the 70 sheet spreadsheet behind this, but like we look at what is their actual business plan, their operations. So we look at team, we look at the comms, their communications, how do they communicate with investors, and their values. And that's really it, is like track record, approach, team, communications, and values. And some people in real estate I have found, and certainly a lot of the tech industry quants that I know very well, like the data scientists and the software engineers, when they hear me mention values, they're like, well, how do you test for that? And I'm like, well, let's take a step back here. You're investing in a business, and in business, in life, stuff happens and it is not part of the plan. So regardless of what decimal point you run the analysis down on that spreadsheet for that one deal you want to invest in, no one had that down on their pro forma for COVID to hit, to your point from earlier, Felicia. No one expected necessarily for interest rates to spike at the severity and speed they just did, faster than any time since the 80s. So none of that was in a plan somewhere. So why does values matter? Values matters because I want to make sure that if I've invested 6 figures with a team, they might have had a beautiful plan laid out on paper. They might have bought a great looking building, but what happens is it's like the Mike Tyson quote, right? Everyone has a plan until they get punched in the
Yeah.
face.
Yep.
So they have to show up and adapt. And that's really what you're testing for with the values. And are they doing the right thing for the people living in the building? Because that is
Yeah.
absolutely something I wish I heard more of when it
Yeah.
came to investing in real estate.
Yeah. That's very important to me and my team, my folks too. It's like, what are we doing? Are we building it up and getting kicking people out that have been living there forever, or are we making it so that people can live there and improving the neighborhood in general.
That's
It's really
right.
important. How do people get in touch with you and your team?
Yeah, they can find us at our website. It's at MadisonInvesting.com. And on there, they can just request an invite to join our club. They will have to talk to me, but this is a strategy session. This is something where I like to nerd out with folks and just get to know each other.
I think once Spencer, you'll feel comfortable and knowing you just watch people for a while. Let me say this. I would never meet somebody for the first time and then invest with them. That's
That's
just
right.
not how it works. Watch, you pay attention, you talk. Are they talking the same talk every time? Or is the story changing? You really use your gut, really pay attention to what's going on. You'll know the right people. And does the best thing happen every single time? It sure does not. It doesn't. But if that person or that group has the values that we were just talking about, they let you know exactly why, to the best of their ability, the thing didn't go the way it was supposed to go. They don't hide. They don't not answer your call when things are going badly. You hear from them. And I've been in bad sleep. Oh my gosh, some deals just don't go the way you think they should go.
True.
And you don't want to talk to anybody, but you have to talk to people and figure out what the heck happened. Anyway, it happens. So, Spencer, thank you so much. You guys, all his information, the contact information will be in the show notes. Check them out. Follow them, follow their website. They got their deals on there, the deals they've worked on, the deals they've closed, stuff they got coming up. Just start paying attention. Start paying attention to as many investor people as you can so you can just start getting on it. We don't even plan to start investing, just start paying attention. That's my advice. Spencer, thank you so much for coming on. I really, really appreciate it. And we will see you guys next week.